Okay, so we are back and the stock markets are closing up, and it is official. We are in an official bear market now. We are now down over 20% from the highs of over 29,000 on the Dow. The oil markets are still in peril. Oil stocks rallied yesterday on hopes of the bailout press release, and many oil stocks cratered today. Again, and I'll repeat this, be very, very careful if you are bargain hunting in the oil market looking for dividend yield. A lot of people over the last couple months bought oil stocks thinking that they had the bottom, thinking that they would get good dividend yield, and those were yield traps. I addressed this for a Patreon account podcast yesterday, warning people, going through a case study about this poor guy who knew extensive amounts of research on the dividend history of Occidental Petroleum, bought a lot of shares last month when the stock was around $26 a share, and he's ridden the stock lower and lower and lower. He still thinks the dividend is going to be re-implemented at a lot larger in the near future, and he fell for the yield trap. So again, it's a public service announcement for people who do not want to sign up for my Patreon. Go and look at the dividend payout ratio. If you are going to buy oil stocks, if the dividend payout ratio, just my opinion, as an analyst in the oil and energy industry trying to save people from getting cut 50%, 60% in a short amount of time, and dividend cuts can do that. The dividend cut from Occidental Petroleum yesterday alone was 86%. Imagine needing income from that stock, thinking that you found a bargain with Occidental Petroleum last month, 11% dividend yield last month, and all of a sudden your income from that dividend stock is slashed 86%. And it might go lower. The dividend could be slashed more. So the point of that audio podcast yesterday was to walk you through the dangerous activities of buying oil stocks and other commodity stocks, thinking that you're getting a good dividend income when things could get slashed. So it is a bloodbath in stocks, bloodbath in oil stocks, bloodbath in gold stocks. The bloodbath in gold stocks is completely and totally unjustified. The baby is being thrown out with the bathwater. Oil prices have been basically halved since the first week of January. Paper gold prices are only down about 5% recently, very, very little, but some really quality gold stocks are down more than 30% in the last month. I'm getting tons of messages below videos, messages below audio podcasts and articles from Patreon account contributors. I can't answer everyone's questions individually. I have over 50 emails and messages that I haven't gotten to yet, so I will try to do an audio podcast update in the next couple days. But for Patreon account contributors, for $5 a month, you're going to get value there. However, the reason I'm doing this show is I believe we have a big repo spike again today. So repo has basically, for months now, from the end of December to the first week of January, repo was in a lull. So the amount of repo madness, and I'm not going to do funny voices today. I'm going to be completely brutally honest and sober about what I really think is going on. I did extensive research on this in the last, I was researching this for the last couple hours. I even took a look at Wells Fargo's annual report. I'm going to talk about that in a little bit. So what I think has happened, because the oil market has gone down so much in the last 6 weeks, more than 6 weeks, the last 2 months, give or take, since the first week of January, it's been halved. That the oil derivatives market, which according to the Bank of International Settlements here on their website for the first half of 2019, I didn't see any second half of 2019 numbers yet for the Bank of International Settlements. So according to this, they're for commodity contracts for global OTC derivatives market in billions of US dollars for other commodities, and I assume they have a separate line item here for gold and other precious metals, but the majority of notional amounts outstanding for commodity contracts, global over-the-counter derivatives, in notional amounts outstanding and gross market value are oil derivatives contracts. So there are, after the first half of 2019, there is over $1.285 trillion in global OTC derivatives for oil derivatives. And then for gross market value, there's about let's see, 163 billion. At the end of the first half 2019. They have not, the Bank of International Settlements on the website has not updated that yet. So in the last couple days, we have gotten big spikes in repo. I think what has happened, this is my educated guess. Again, I don't know if we're ever going to find the truth out about this. President Trump right now is marching. He was marching out bank CEOs. He was having meetings with the bank CEOs. And the bank CEOs were telling everyone that everything's fine, that there's plenty of liquidity, plenty of loans. I think what in actuality is going on behind the scenes is that either one or two or three very large hedge funds or one or two or three very large banks had a big boo-boo, a big blowout with the bad oil loan debts and or the oil derivatives. That is what I think has been happening. Now, Rob Kirby, I respect Rob a lot. Rob said in September, mid-September, remember, September, late night, September 16th, 2019, and then we started getting the press releases the next day, September 17th, 2019. We started getting the press releases about Repo Madness. Now, Rob Kirby at the time said that was oil market related. There was not nearly as much fall in the oil market back then, nearly as much volatility in the oil market as there has been in the last 2 or 3 months in the oil market. So the amount of volatility in the oil market is insane. And I suspect that banks and or hedge funds were caught on the wrong side of this trade. And I suspect that some of them may have already failed and they're on life support or zombies being kept alive through repo and currency swaps. So that's what I suspect is happening right now. The dollar index is rallying shockingly. So it had been weak, but now it's back up over 96 at 96.56. So the dollar is acting really weird. Again, this is the volatility in the dollar. When it gets too high, it comes back down. When it gets too low, it goes back up. This fits in with my dollar tug of war thesis. And the dollar's just been, moving up and down inside a trading range for a while now. So every time the dollar starts going up, you have the dollar bulls like Brent Johnson, Raoul Powell, and Shy Girl Tracy Schuchart on Twitter saying how much the dollar is going to get even stronger. It's going to go to 105 on the dollar index, even stronger than that, and collapse everything. But then the dollar doesn't do that. The dollar was above 99 on the dollar index from I think February 12th to February 25th, give or take. And then when the dollar starts getting weak, you have people like Luke Gromen and other gold bulls and other people who hate the U.S. and U.S. government and hate Americans in general and want China to win, claiming that the dollar is about to go into complete and total free fall. And the reality normally is that the dollar just ends up staying in a range. And that's why so far the dollar tug of war thesis that I have is holding true. It just, when it gets too high, it drops. When it gets too low, it goes back up. And so there's two very powerful forces that I highlighted. If you haven't seen the video yet, it was done the first week of January. Go and look it up in the archives later, dollar tug of war. Okay, so let me talk now about the record amounts of repo. As you can see there on your chart, the amount of repo is absolutely enormous. The overnight repo set a record. So we have not had this big a repo spike in months, and this is actually a record for overnight repo. We were at 132 billion oversubscribed in repo for a single night for overnight borrowing for today. That is a record, folks. So that is more than in September. It's more than in October, September 2019, October 2019, November 2019, and December 2019 and January 2020. We are higher than those. And recently, the size of the term repos was increased again. So after the size of the term repos, which is where banks can hold the borrowed capital, they get control of it for longer than overnight. They get control of it for 14 days. Depending upon the repo, they get control of it for longer. So now these banks have control over those term repos for at least 14 days. And the size of these term repos are, I think they switched. So initially they were like 25 billion, and then the Fed reduced them, I think, in the last couple weeks, maybe month, down to 20 billion for size of the term repos. And then they started increasing the amount of oversubscription on the term repos started increase. And now the term repos have been increased in size, a lot of them back up to $45 billion for the term repos. So we're looking at massive amounts of repos again. In my opinion, the repos are related to derivatives, oil derivatives, because of how much volatility we've had in oil price, and hedge funds and banks. Well, hedge funds were caught on, at least a couple large hedge funds were caught on the wrong side of the oil trade. So there were hedge funds that were probably long oil futures contracts, oil stocks initially over the last month or two, and they've not been able to unwind those trades. So they didn't hedge. Again, this is a common theme with a lot of hedge funds. I've been speaking with a lot of hedge fund managers for years now, that I always ask them when they get trades wrong if they've learned anything, and then I ask them if they admit they actually got trades wrong, if they actually hedged their trades. And a lot of them, when they short or do other types of sophisticated trades, they admit to me that they don't hedge. So we have hedge fund managers who leverage up ridiculously high with ridiculous amounts of leverage. Maybe they leveraged on treasuries the wrong way, and then they don't hedge their bets. They leverage up and make a one-directional bet. That is an all too common theme nowadays for a lot of hedge funds, unfortunately. And we also have a lot of bad oil debt. So I wanted to talk about Wells Fargo. So Wells Fargo Bank, at least in 2016, had the most oil exposure of any of the large banks. So 2016 was the most bankruptcies recently for Shale Oil and other companies. Now, the Saudis did attempt to kill the shale oil companies starting, I think, in 2013 and 14. So they refused to cut oil production, and the oil price at the time, everyone thought that shale producers could not make any money if oil dropped below $65 a barrel. I remember when I was an oil analyst and we were discussing this in-house, we were looking at other people's research, and pretty much the consensus for the industry was that at $65 a barrel, I was reading a bunch of different research reports, that at $65 a barrel, a lot of the shale oil companies were in trouble. Now, it turned out to not be true, and one of the main reasons was how much capital, in terms of junk bond debt, in terms of dumb pension fund money, funding the shale boom, was available. So these shale companies were given a lot of extra leeway to keep raising capital with junk bond debt and equity, which is shares, to keep their businesses afloat. There was nowhere near the amount of bankruptcies in 2016 that everyone thought. So people thought there was going to be unbelievable amounts of bankruptcies in 2015 and 16. There was a decent amount. So there was a pretty good amount of bankruptcies. I don't know the exact number offhand. But anyway, the shale oil companies were able to cut production costs, and a little bit at least. So a lot of shale companies that are higher cost now still can't produce shale at a profit for 50 to 55. Now the Permian oil producers are producing lower than that, but overall the industry is not able to make consistent free cash flow at least 55, 60, $65 a barrel. There is an interesting chart out here that I have from Goldman Sachs. It's in the Wall Street for Main Street Facebook group. And it's showing that if you account for all the dividends and to cover all their capex bills to maintain property, plant, and equipment, that the U.S. big oil companies, the break even for a lot of the big large cap oil companies is, for the U.S. ones, is at $60 a barrel. There's mostly right at $60 a barrel. A couple of them are over 60, near 65. And that is, there's one or two of them that are right below $60 a barrel. So we need these large cap super major US oil companies need oil prices at least $60 a barrel just to maintain their dividends and not cut their capex bills, which is what is required to maintain a healthy company. Oil is very capital intensive. So oil companies can delay capex spending, capital expenditure, for a little while, but if they delay it too much, then the property, plant, and equipment to maintain oil wells, maintain natural gas wells, things like that, pipelines, refineries, that these large super oil companies, they have refining businesses, they have exploration and production, and then they have like petrochemical businesses and some other business segments. I think they sold off most of their gas stations. A lot of them sold them off, so it's owned by franchisees now, a lot of these. So we're way below the oil price. So it would not surprise me, again, warning about dividend cuts. Not every oil company is going to cut their dividend, but it would not surprise me if many more did. And it would not surprise me if some of the larger players like Chevron or Royal Dutch Shell maybe cut their dividends a little bit. That would not surprise me. It depends how low oil prices stay and for how long. But these oil prices are not sustainable. The industry, if oil prices were to go lower for 6 months, 12 months, I mean, the industry would be bankrupted fairly quickly. And that's why you have President Trump talking about bailouts, because he sees this. He sees the amount of shale junk bond debt. There was a very good Zero Hedge article out today. Let me see if I have it here. Okay, Fallen Angel Day arrives. 140 billion in energy debt at risk of imminent downgrade to junk. So it's talking about how much shale oil debt is at triple B, how much can be downgraded. Also, there's been 2 leverage oil products shut down in wake of the oil price crash. This was a Bloomberg article from yesterday by Jakob Petersale. And then there was an emergency plunge protection team call too. And after Monday's market crash. And I suspect that it was the bankers having to report their oil exposure. Oil and oil derivatives exposure. That's what I suspect it was. So Rob Kirby said that the spike in repo was in September. I think the spike in repo now is oil debt related and oil derivatives related. That's what I suspect. And none of those repo problems were really solved. Zoltan Poznar just wrote a research report. He's talking about the Fed will have to do even more QE. The Fed will have to open up currency swap lines. You know, all the crazy things that we hate, all the bailout stuff. This is why Trump is talking about bailouts. There's 2 articles that I found about some of the banks, the smaller banks that have shale debt exposure. So this one's from Brian Chung, Yahoo Finance reporter, came out yesterday. Energy exposed banks attempt to bounce back after second punch from oil prices. Monday's brutal sell-off hammered the banking industry as bond market volatility sent rates crashing, but banks with high energy exposure endured a double whammy from the oil war triggered by OPEC on Sunday. Some energy-exposed regional banks, such as Houston-based Cadence Bank Corporation, lost over 30% at the market close on Monday, while Oklahoma City-based Bank 7 Corp lost over 25%. In the first few minutes of trading on Tuesday morning, banks were riding the broader market in recovering some of those losses. So the KBW Nasdaq Bank Index, which is BKX, so BKX, gained over 6% as shares of Cadence jumped over 10%. This was a rally yesterday. And shares of Bank 7 surged at over 11%. I'm sure they're probably back down again. I haven't looked. Stocks across the board paired those gains in the late morning. Still, KBW analysts wrote Monday that the collapse in oil prices to levels around $33 a barrel are worrisome for banks with substantial business ties to oil and gas companies. The concern is that lower oil prices will crunch margins at companies borrowing from those banks, thus worsening credit quality. Quote, the depressing energy pricing will be problematic in our opinion for those banks with legacy problem energy loans. KB analysts Brady Gailey and Wood Lee noted they flagged Texas Capital, Independent Bank Group, Hancock Whitney, and Cadence as examples. On Sunday, crude oil prices fell by more than 30% after Saudi Arabia slashed prices after negotiations on supply fell through among OPEC nations and Russia. They also announced that they would potentially increase oil production massively. We also, and this was the headline, one of the headlines on oilprice.com today, there is another country that wants to increase oil production. OPEC's third biggest producer, the United Arab Emirates, wants to increase oil production too. So again, this is counterintuitive. In a free market, producers would not be increasing production while oil prices are falling. They would be cutting production. So the oil market, we do have price discovery here with the oil price actually pricing in demand totally collapsing out of China, the global economy, cerveza problem related things with the lack of air travel, travel restrictions, people voluntarily not wanting to travel. The professional sports here in the U.S. look like they're all going to get shut down. The NCAA tournament might be played without any fans there. that's looking increasingly more likely, with a lot of these college basketball conference tournaments now being either canceled or no fans are allowed to be in attendance. And the policy for a lot of these professional sports leagues now is no media in the locker rooms. So this is a perfect storm, worst case scenario for oil, and I think this is why President Trump and the banks are panicking. Wells Fargo, so I said I was going to talk about Wells Fargo now. Wells Fargo's 2019 annual report is not out yet, so I was only able to look at their 2018 annual report. And so I did a Control F search here for oil, and on page 65, 63, of a 288-page document, they talk about how in 2016, they only had a provision for loan loss of $1.1 billion for 2016, and that was when the oil and gas industry got killed. So that was way too low. And according to this, I think they claim to only have, let me see here if it's on the next page. I think it's on the next page here. Let me go move here to the next page. I think they only have about 12.8 billion in energy. They only claim to have about 12.8 billion as of their 2018 annual report, about 12.8 billion in oil and energy loans. Yes, here we go. So this is now on page 76 or 77. Click on there. Yes, it's 76 of 288. The oil and gas loan portfolio totaled 12.2 billion, or 1% of total outstanding loans as of December 31st, 2018, compared with 12.5 billion, or 1% of total outstanding loans at December 31st, 2017. Oil and gas non-accrual loans decreased to 416 million at December 31st, 2018, compared with 1.1 billion on December 31st, 2017, due to continued credit improvement in the portfolio. So there's talk about risk mitigation strategies and other things in there. The banks sound like they're not reserving. Wells Fargo at that time in 2016, when there was a lot of bankruptcies, Wells Fargo was looked at as having the largest energy loan portfolio of any of the large banks. So Wells Fargo, I believe the numbers that they only had 12.8 billion in energy loans at the time, and the only loan loss reserved about 1.1 billion. I don't know if those numbers, they put them there and the lawyers approved that. The corporate lawyers approved that. I'm not sure if those are the real numbers. There was rumors that at the time that the loan losses were way larger than that. Because we have hundreds of billions of dollars in triple B and Shale junk debt. I think the actual number, if you add up all the junk bond debt and all the triple B rated energy junk debt, is actually over $1 trillion. And then there's the derivatives that could be tied to that, the energy derivatives or credit default swaps on some of the bad debt for the oil companies. And when you have that much energy debt and that much derivatives, it doesn't take that much. It only takes one or two counterparties failing. So if a whole slew of small and medium-sized banks are failing in Texas and Oklahoma, and then maybe those counterparties with those smaller banks are one large bank, and they're getting a bunch of defaults, that's all it could take to go into the repo market. That's what I suspect is happening. Again, we may never find out the truth about this. I don't think they want us to find out about the truth. Yesterday, there was a record $216 billion in liquidity from Fed repo. When you add up overnight repo and term repo together. And today was even more. And this is why you have the plunge protection team. So it's not just the stock market falling. Although the stock market falling makes the debt to equity ratios really bad. Makes the debt to equity ratios for these oil companies bad. It makes the debt to equity ratios for these smaller banks with bad loans going bad. It makes them look bad when their stock prices collapse, and then their loan book is going bad too. So it becomes a vicious cycle. And this is why the Fed normally steps in times like this at some point, and the Fed starts overpaying, paying full price for stuff going bad. For stuff that's worth less than 10 cents on the dollar, the Federal Reserve comes in and pays 100 cents on the dollar. This is what has been happening historically now for over a decade. So instead of allowing any free market forces or any capitalism, although smaller firms may be allowed to fail, any larger firm, like a larger shale oil company that Warren Buffett may be invested in, or a larger bank that has too much oil energy derivatives exposure or bad energy loan debt. And this is why a lot of professional money managers, even though gold stocks will do very well, the Q1 2020 margins should be spectacular with gold prices where they are and oil prices falling. The miners are literally, this could be the best record margins for mining companies, probably even better than 2011, because in 2011 you had oil prices and other costs for mining going astronomically higher. Most people aren't aware of this, but as gold prices were around 1900 before they collapsed in 2011, the costs of mining, so all the materials to build the mine, the energy costs, the truck tires, my buddy Steve St. Angelo talks about this at length, the truck tires for those massive earth mover trucks to mine back then, they were going from like $5,000 per tire, and you have to use a lot of these tires because the mines run 24/7, 365. There's an overnight crew. So there's day crews, like 12-hour shifts, and then there's an overnight crew. And the mining tires for some of these earth movers, the Caterpillar ones at the mines, were going from like $5,000 per tire up to $40,000 per tire. The costs were out of control. So when gold got to 1,900 an ounce in US dollars back then, the costs of mining were actually rising faster than the gold price was. And it was that way for over a year. So the gold miners were producing really high profits and pretty good free cash flow, but they were nowhere near the margins that were expected. But at this point, with energy prices falling and gold prices still high, the margins should be spectacular. Unless the management team's totally inept or there actually is an outbreak either at or near a mine in the local community. You know, it's funny. So, like I said, the baby's getting thrown out with the bathwater. Some of my Patreon account contributors are asking for exact price targets or buy targets on the gold and silver mine stocks. This is why you don't buy your entire gold or silver position at once. You buy, this is just my opinion, you buy a little bit, and then if it goes down a lot, maybe buy more. And I've been doing this for years. I've had a lot of success with it in the past when Sandstorm Gold crashed down to like, at one point it was below $3 a share, and I bought a lot. So hopefully I will have enough money coming in where I can buy maybe another 1,000 shares or so of Sandstorm Gold soon. It might happen, we'll see. That would be a pretty big purchase for me. Since everyone's going to ask about that, I have the company valued at $1,500 an ounce gold at $1.4 billion. They have a new gold stream coming online in the next month, in April. So, little financial detective work. When you put the pieces to the puzzle together, it looks like the oil price getting halved, give or take, over the last 2 months, is wreaking havoc with a lot of these banks' energy loan portfolios and oil derivatives contracts. And it's killing the pension funds too, because the pension funds, they have not dumped all their oil investments, and the pension funds were holding shale-related junk bond debt and shale-related equity. So the pension funds had stopped adding new amounts of junk bond debt and buying new amounts of shale junk bond debt and buying new amounts of U.S. shale oil company shares, but they could not dump them all. And I think now you're seeing liquidations of those positions. Wow, Saudi Arabia selling oil to Europe for only $25? That's crazy. So we'll see what President Trump announces tonight. I wonder if it's going to be related to the outbreak, or if it's going to be related to the banking system or related to the oil market. I suspect that President Trump will eventually do a bailout for the shale companies. Because if some of these shale companies go, the banks could go with them. Some of the hedge funds may go with them. So the Wells Fargo 2019 annual report is not out yet. It will be interesting to see if there's any big changes in it. They were the big player in oil and energy debt and shale bond debt. Not sure if they still are. But I have another couple articles here if you want to read more about the smaller banks that are holding the most shale exposure. So this other one's from Philip Van Dorn, out today. Opinion, you should avoid shares of these banks with too much oil and gas exposure, is the article from MarketWatch. And he has a whole list of companies and their energy loan exposure. And there is how many companies, how many banks here? One. There's 16 different banks, mostly in the Midwest and the South, that have way too much oil and energy exposure. According to this article, JP Morgan only has 7% of oil and gas loan exposure. Bank of America only has 10%. Citigroup has 15%. That's pretty high. And Wells Fargo's only 10% oil and gas exposure. And he's citing the newest 10K. He's citing the newest 10K from fourth quarter, I think, of 2019, and I'm citing their annual report, which the annual report tends to have the most information. So if you want to do a deep dive on many of the different topics that I discussed on this live stream show, all the article links will be in the information and description section below the video, along with my Patreon account link, because people always ask the link for my Patreon account. It's below every single video in the information and description section. I guess people don't check there, but I cite my sources, so all the article links discussed will be in the Patreon account. All the links discussed will be in the information and description section. The bottom line, though, is if oil prices stay this low or go lower for another 6 months, 12 months, there's going to be wide-scale bankruptcies. And I suspect that is why President Trump and his Treasury Department and the Federal Reserve are already discussing how the Federal Reserve will buy up some of this toxic stuff now and pay 100 cents on the dollar, or how President Trump will offer maybe some type of low interest rate loan program and then the loans are magically forgiven. When most people have forgotten about them. Sean says this is full-blown economic warfare like James Rickards warned about. Yes, I agree. OPEC, the Saudis, OPEC, and Russia are going for the kill shot. They want market share back. They know that most likely oil prices will be higher in the next couple years, and they can get their market share back. So they're willing to run at a loss for now to bankrupt Shale. Look, oil prices are going to have to be higher in a couple years. I don't know exact timing on that, but they're going to have to be higher. And once there's a vaccine for the outbreak that's going on now globally, the pandemic, that the World Health Organization finally admitted it's a pandemic, those freaking assholes. The World Health Organization and CDC have totally shit the bed on this. Many regulators in Europe, here in the US, Japan, it's a disaster. And China's a mess. China's claiming that there is no more infected people or dead people. It's just ridiculous. But eventually, a year or 2 years from now, when there's a vaccine, people develop immunity, the demand for oil will return. And the prices are going to have to be higher. All the oil companies are not going to go bankrupt. You're going to see government step in. If European countries have to step in and do bailouts, the European Central Bank will do bailouts of energy companies. The Federal Reserve will do bailouts. I suspect the currency swap lines are already opened a lot. And that started about 2 weeks ago. Okay, I'll look at super chats and then that's it. Patreon account contributor Justin sends me $1 super chat. Thank you, Justin. I appreciate you chipping in. Okay, super chat from JB Wild, $20. Thank you very much. He says, late to the stream and new subscriber. Thanks for your knowledge and insight. I'm in deep in midstream oil. It's been a rough few years. Sorry to hear that, JB. I've been warning for at least 8 months to avoid. I hope you bought some puts. I've been warning about oil problems. I obviously didn't see the global pandemic that was coming because that's totally collapsed demand for oil. Because the Chinese economy, the global supply chain, people are not traveling. People are scared. A lot of people are scared to travel. Deservedly so. Rightly so, I mean. Linked on Air says bye-bye pensions. Yeah, my dad was panicking today. He's worried because his retirement account is down a lot. I think he said his retirement account, he just lost 20 years of gains. My dad does not agree with a lot of the things I say on this podcast, and most of his investment portfolio is conventional stocks. I warned him many times. He does not have hedges in, does not have put protection with options, does not have a gold position, does not have the right gold stocks. He had a lot of regular stocks, and he did not take profits off the table. He was just, with that hysteria that Trump was claiming, Dow's going to be at 30,000. His tweets, I should do a video on this about like Trump's tweets marking the top in the stock market, and then the Economist cover about how the large cap technology stocks are going to have $2 trillion market caps. Do you remember that cover? That was last month, I think. Maybe it was 5 or 6 weeks ago. I think it was last month. And then the Barron's cover from like 6 weeks ago, give or take, that the Dow was going to hit 30K in a week. So those indicators, along with the Trump tweets, Zero Hedge getting banned on Twitter, the Economist cover, and the Barron's magazine cover, those in hindsight mark the top. We're in an official bear market now, folks. You know what happens in an official bear market? The trading algorithms go into automatic sell. They start fading all the rallies now. So something has to come in and convince those trading algorithms that are programmed to not sell all rallies. What's going to convince those trading algorithms to not sell all the rallies? What's going to convince those trading algorithms to not short all oil stocks, not short all banks, not short all airlines, not short all hotel and casino stocks? What's going to convince the trading algorithms? No, at some point the Fed's going to step in. I don't know when. At some point the Fed's going to step. The market's already pricing in a couple more rate cuts over the March Fed meeting, which is next week, and the April Fed meeting. Maybe the Fed does emergency cut sooner. There's rumors. One of my friends just told me before I turned on the live stream, he thinks 100 basis point rate cuts coming. I don't think that's enough. The Fed's going to have to step up and do something insane. Like we're talking not even 120 billion a month. In QE, we're talking like over 150 billion a month, maybe 200 billion a month in QE. Because the direction now of the market, all the professional traders are in cash, in gold, in treasuries. They've set up shorts, they've set up hedges. That's what the professionally managed money are doing now. They're in extreme risk off. They are not long. Very few. They're net long. Very few things. Been speaking now for over 30 minutes. Maybe TLT. That's the long treasury one. What is it? TLT? Yeah, TLT. TLT's gone up a lot for a while now. Maybe they're a long TLT, but I would be careful about that. I mean, there's a lot of gains there already. Eric says the shorts are going to send the market higher when the tide turns. The question then, Eric, is what is going to turn the tide? Is it the Fed? Probably the Fed. How much is the Fed going to have to do to turn the tide? Because I think they're already doing currency swaps. I think something else broke. Something else connected to the repo market broke, or a new borrower that was not borrowing in repo since September, October, November, December 2019, early January 2020. A new borrower that was not tapping repo to prevent from going bankrupt is now tapping repo. Apparently now, a lot of banks and or hedge funds tap repo out of desperation to avoid going bankrupt. Okay, well, I think I've talked enough. So all these articles I talked about. So funding freeze getting worse. Dealers demand record $216 billion in liquidity from Fed repo. That came out yesterday. 2 leveraged oil products to shut down in wake of epic crash. That article came out yesterday. Plunge protection team holds market conditions call after Monday's market crash. That article came out yesterday. Trump administration expected to seek aid for shale companies hit by oil rout. That came out yesterday. And then today, fallen angel day arrives. $140 billion in energy getting tongue tied here since been speaking for over 40 minutes. Fallen angel day arrives. $140 billion in energy debt at risk of imminent downgrade to junk. That article came out today. And then the couple articles about in the last couple of days about which smaller and medium-sized banks in the South and Midwest here in the United States have the most exposure to shale loans and energy debt, if you want to read those. Also, I'll attach a link to the Bank of International Settlements table on global OTC derivatives market. But we could have a large chunk of those notional amounts outstanding of oil derivatives over 1.2 trillion from the first half 2019 figures, according to the Bank of International Settlements, going bad now because of the volatility in the oil price, how much the oil price has gone down. No one saw the demand destruction coming with the global supply chain, with China, with the global pandemic causing travel restrictions and travel bans and people voluntarily not going on vacation or traveling for business. No one saw that coming in advance, and which means that they did not hedge their derivatives positions, which means someone, at least one large player, got caught off guard. Also, Dr. Kent Moores wrote this article a couple years ago talking about how the oil derivatives were at least 25 to 50 times larger than the total amount of oil available for purchase in futures contracts. So all told, according to this article is a couple years old, 2017, Dr. Kent Moores, who I've interviewed in the past in the archives of the channel, an oil and energy expert, derivatives add up to between 25 and 50 times the total value of the oil upon which they are increasingly only tangentially based. So something broke when the oil markets since the first week of January have crashed more than 50%. The oil stocks are down, and this energy debt's in peril. At some point, the Fed will have to step in or risk, black hole vortex. And the Fed will definitely step in. We don't know how long it'll take, how big they will have to go. I don't think rate cuts at this point are going to solve anything. The Fed is going to have to do helicopter money drop or something even larger than that. They're going to have to go in and pay 100 cents on the dollar for toxic asset garbage that is worth 10 cents on the dollar or less. Because this is very similar to how assets turned into liabilities in 2008. Okay, everyone. Well, thank you for listening, and all the articles mentioned will be in the information and description section below the video. And thank you very much to my almost 500 Patreon account contributors now. That is amazing. How quickly things have grown in the last couple months. People are chipping in, stepping up for $5 a month. You can get in as cheap as that. I think it's definitely worth an overpriced cup of coffee extra per month. And there's a lot of audio podcasts, articles, and chart work behind the paywall there. And I will try to get out in the next day or two some additional analysis, since there's lots and lots of requests for some of the gold stocks valuations. I'll try to get something out about that. People have been asking about some of the speculative juniors. Again, I don't have a lot of speculative juniors for gold and silver stocks, because in this environment, even with gold prices at these levels, there is not capital available for most of those juniors to build a mine. There's capital available for most of those juniors to raise a little bit of money to do a drilling program. There is nowhere near the amount of capital available for those juniors, even at these current gold prices, to go and build a mine. It's sad, but that's how it is. A lot of it is thanks to these gold mining ETFs. That's where most of the capital is going. It's going into the large cap gold stocks and into gold ETFs and royalty and streaming companies. That's where the majority of capital is going. Until that changes and juniors are able, even at gold prices at 1,700 when we're back there, or 1,800, we may have an environment where gold prices are that high and juniors still cannot raise capital to build a mine. Or very few juniors are able to raise capital to build a mine, because a lot of people have decided that gold mining ETFs are more efficient and that royalty and streaming companies are going to do most of the financings now. That's the new normal we have for the gold and silver markets. Royalty and streaming companies are handling a lot more of the financing for the juniors, along with the larger gold mining companies making smaller equity investments and right of first refusals for partnership deals or joint ventures to build a mine. That's what you have with Mag Silver. Mag Silver is not building their mine. It is Fresnillo, which is the world's largest primary silver producer out of Mexico. They are building the mine, and Mag Silver owns 44% of the mine. So that's a good partnership for Mag Silver. They're not taking the risk that most juniors have to take. Normally with a junior mining company, they have to raise a bunch of debt, dilute their shareholders, and gamble the entire company on bringing one mine on time and on budget. Okay, everyone, thanks for listening.